China's trade surplus has crossed $1 trillion for the first time. This is not just a large number, it is a reflection of deeper economic shifts inside China, and it has direct implications for the ongoing trade tensions between China and the United States. So let's break this down carefully, step by step. What this surplus actually means, why China's trade surplus has risen so sharply, and how it feeds into the evolving US-China trade war. First, exactly what is China's trade surplus? A trade surplus simply means a country exports more goods than it imports. But China's surplus has now crossed $1 trillion, which is unprecedented. To put it in perspective, this gap between what China sells to the world and what it buys is now larger than the annual GDP of many developed economies. This tells us two things immediately. China's export engine is extremely strong and its import demand is significantly weaker than expected. Now, what is driving this surplus? There are three major drivers and all of them are important. Number one is weak consumer demand inside China. China's domestic economy has been under stress. Household spending is low, the property market is struggling, and confidence among buyers is subdued. This means Chinese factories have fewer customers at home. So production is redirected outward toward global markets. Number two is strong export competitiveness. China's manufacturing ecosystem remains highly cost-effective. Economies of scale, established supply chains, and a competitive currency all help Chinese products remain cheaper internationally. Even as relations with the US have strained, China has expanded shipments to other regions: Europe, ASEAN countries, Latin America, and Africa. Number three is sluggish imports. When domestic demand is weak, imports slow down. China simply isn't buying as much oil, machinery, luxury goods, or components from the world as it used to. This widens the surplus further. So the surplus is not only about China exporting a lot, it is also about China importing less. So how does this tie into the US-China trade relationship? This is where it becomes significant. The United States remains deeply concerned about two patterns: China's ability to produce far more than it consumes, and China's ability to sell those goods in global markets at a very competitive price. Even though tariffs imposed since 2018 have reduced some US-bound Chinese shipments, the overall export strength has not weakened. China has simply diversified away from the US and expanded into new markets. But the implications still fall back on the US in several ways. When Chinese goods dominate global markets, prices of products like solar panels, electronics, machinery, and electric vehicles decline. This puts pressure on American manufacturers who cannot match these production costs. US officials argue that China produces more than demand requires, particularly in sectors like EVs, batteries, and green technology. This excess production then flows into the world at low prices, affecting industrial competitiveness. The US has already responded with tariffs, trade barriers, technology restrictions, and supply chain diversification plans. But a surplus of this scale reinforces the view in Washington that existing measures may not be enough. In short, the $1 trillion surplus becomes another data point, reinforcing American concerns over China's export-driven growth model. Does this mean tensions will escalate between the US and China? Well, the US can tighten scrutiny of Chinese imports in sensitive sectors, push for domestic manufacturing incentives, and strengthen trade partnerships with alternative suppliers. China, on the other hand, is unlikely to shift its strategy quickly. With domestic demand still weak, exports will remain a key pillar of its growth model. Finally, what does China's $1 trillion trade surplus milestone indicate? A $1 trillion surplus does not signal a booming Chinese economy. It signals a rebalanced one, leaning more on the external sector because internal demand is soft. It tells that China's manufacturing strength is intact, its export competitiveness remains high, its domestic economy is still finding its footing.
If you like this video, then like, share and subscribe to ET Now.